Just a little advertisement here. As Eric said, I host a radio show called Turning Hard Times into Good Times. Most people don't listen to it live. It is a live show that airs from 12 to 1 o'clock Pacific time every Tuesday. But it's the following day, it's up on my website at J. Taylor Media as a podcast where you can watch it there. And also go to miningstocks.com where you can sign up for my newsletter. You can also follow the companies that I follow and see the news releases, because I have links to the news releases of all the companies that I follow in my newsletter there as well. I have titled my talk, "A Tectonic Shift in Markets is Underway." And what you see there in front of you is what I call my inflation-deflation watch. It's just simply it's just simply a list of equities that try to attempt to get a broad-based understanding of whether equity markets are expanding, and this would be Indian stocks, Chinese stocks, S&P 500, auto stocks, housing stocks, a broad base of equities around the world. And then I have key commodities like oil and copper and silver, gold, and the Rogers Raw Materials Fund, which is a composite of broad-based commodity index. And the main reason for this was try to determine whether or not the global economy as a whole is expanding or contracting. Well, you can see the very sharp contraction that occurred 2008, 2009. And instead of letting it go, instead of letting the markets find their place, their equilibrium, of course, the policymakers couldn't keep their hands off of it. The bankers had to be protected. The banking and the ruling elite had to be protected, so the bankers were saved. And we went up with QE1 and QE2. The problem is increasingly it's been ineffective at stimulating growth, global growth. It helped us avoid the cataclysm, but it provided a whole lot of new problems as well. Now, Eric mentioned some technical analysts, and one that has really been very, very good, and I have him on my show almost every week, is Michael Oliver with his momentum structural analysis. And in late 2015, he started talking about a tectonic shift among the major markets. And he was looking at the bull markets would be evolving shortly, was precious metals, commodities, and the euro, meaning the dollar would start to decline. And the equity markets, the treasury markets, and the US dollar would be in bear markets. And that's what he saw evolving at the end of 2015. So I took a look at the components of my inflation-deflation watch. And from the peak of my inflation-deflation index in 2011 till the end of 2015, you can see the items that did the best. Housing, autos, those are sectors, of course, that were stimulated by cheap money. And stocks and real, stocks basically and real estate and that sort of thing, all stimulated by artificially cheap money. And then last year you can see what happened. It was completely the opposite, with oil on top, copper, silver, the Rogers Commodity Index, and so all of those things that had done really poorly. So I think 2016 was really a transitional year. I think the plates are starting to shift in a major way. The major problem that we have is what I call fake money. Fake money was given to us. It's nothing new, but it's the first time we've had fake money globally and no gold-backed money anywhere in the world. The IMF doesn't allow it. The IMF will not allow any nation to use gold to back their currency because that will get in the way of the dollar expansion and the dollar's hegemony. So dollar hegemony is really what it's all about. And so the United States has been able to expand its empire and create money out of nothing, and the people that have had control of this money have done extremely well. But you see here what happened from the end of Bretton Woods in 1971 when Nixon took us off the gold standard. We see this enormous growth in paper reserves in central banks. This is from Bloomberg. This data is from Bloomberg. And so the idea of the Austrian economist is that the notion of the terminology crack-up boom, which occurs when money is created out of nothing. And you have this massive growth of malinvestment. You have money going into places it would not otherwise go because it's too cheap. It's not market-driven money. It's money that is derived out of thin air by the government. It's a liability money, not an asset money, which is gold or silver. And so you have a huge party going on for as long as you can. But like any kind of addiction, at some point there's limits to it. And the idea here is, and what I believe is probably true, is that we've reached that optimum level of this crack-up boom back in August of 2014, and that we are now starting down in the other direction. Now, this is going to be really difficult for Mr. Trump to try to overcome, because I think the forces of deflation are just absolutely huge. They will have to keep trying to print money, and at the same time, the Fed is starting to show signs that it wants to not print, or I'm believing that the markets are telling the Fed, we're not going to buy your treasuries anymore at these rates. And so the market is dictating, I think. The Fed would have you believe that they're in charge. I don't buy that one. But in any event, the point is that we have far more debt than can ever be repaid. And the markets, and there's some physical limit to that. And I think that that's what this chart is telling us, that we're starting down that contraction phase. In my inflation-deflation watch, it's right on the edge of sort of long-term moving averages, and I think we could be heading for it. Keep in mind that, so the Fed really got us out of this horrible decline that we had in 2008, 2009. We just really postponed the day of reckoning. Now, as long as the Fed continues to finance deficits and print money, that is inflationary. But if the public sector is asked to do it, if money is pulled out of the economy to buy instead of created out of thin air by the banks, then that's deflationary. So it's really going to be a real struggle. But to give you an idea of how inflated and how way off the mark values are, this shows household net worth to GDP going all the way back to 1952, and it shows, you know, several standard deviations above the norm. So it's just all fake, though. It's fake money. It's money that's created out of nothing that's created these values in the housing booms and stock markets and the bond markets especially. Trillions of dollars going into debt instruments created out of nothing. The stock market here, this just shows sort of a historical measure of it. You know, yes, we've had that huge spike in 2008, 2009 because earnings went to almost zero in the S&P 500. We had the big bubble in 2000, which was followed by a cataclysmic event, the bear market after the IT boom and bust. So we're setting at very, very lofty levels in equities now from a historical point of view, much higher than we were in 1929, for example. Now, I mentioned this yesterday in our panel discussion, this regression model that really showed the U.S. budget and the price of gold. And from the time Nixon took us off the gold standard in '71 until 2013, it fit like a glove. 94% of gold's increase or movement was explained by the government's budget, by the U.S. budget, not the deficit, the U.S. budget. So what happened here then? We had this great departure from that correlation. Well, we started, I think what happened was you had Draghi doing whatever it takes, driving interest rates down, Japan doing the same, you had negative interest rates around the world. The U.S. was the first country to start QE, it was the first one to stop it. So I think what you had was an enormous amount of money flowing into dollars and into the equity markets and the debt markets in the U.S., which then caused people to exit gold and go into those other markets, and especially the dollar, which has caused the dollar to be so strong. This is just another chart that shows you this is total debt or total credit in the United States relative to GDP, and you can see that the acceleration occurred after we went off the gold standard in the early 70s. So this allows us to have this sort of addiction to easy money, to fiat money, and we're far higher than we were in the 1932, which was the previous peak. This doesn't go back to, it only goes back to 1951. So this was all really created by what I call fake money. It's what everybody assumes is the proper money, but it is really not the market's money. It's money that governments have mandated for their own purposes and for their friends' purposes. So the Federal Reserve and the bankers that own the Federal Reserve create money out of nothing and redistribute wealth from the people that create it. The miners, the manufacturers, the farmers, the inventors, people that actually do things that create wealth for people are not making out nearly as well for the most part as the guys who have control of the money system, and that's the bankers and the politicians. And this, I think, is a big reason, although I don't think the populace understands it, the reason for the election results in the U.S. To a great extent. There's other issues too, but I think it's a flyover country in America that's really hurting the people that did things and made things that are really, really angry and really distraught. Now we have a Republican, if you can call him that, coming in as president. Don't really know, he doesn't fit the description very well, but if we look at Republicans, they've been awful for the budget deficits in the United States, and this is gross national debt as a percentage of GDP. The green line shows what it would have been if Reagan and Bush had balanced their budgets. And this was a chart from David Stockman, who was a recent guest on my show. He was the budget director under President Reagan. And so you can see, here we go. All of the things that Trump wants to do suggest that it's not going to change. Eisenhower was a fiscal conservative, and some Republicans after that, but in recent years, since 1971, Nixon said we're all Keynesians now, and let's just have a party, and that's what we've done. Now, we've had some debt year-over-year increase in total debt. This chart shows that. We've had a decrease in that year-over-year increase, but it started to tick up even on Obama's watch here. Now, the reason I think that the Fed has to try to keep interest rates down, this shows the amount of debt that is federal debt that is held by the public. The rest of the $5 trillion or so, most of that is held by the Fed. And so we're looking at what happens with just a little bit of an increase in the tremendous amounts of interest expense that it adds. It's just enormous. So the budget can just run completely out of control if interest rates start to rise even a little bit. What can we anticipate with Trump and the policies that he's likely to put forward? Well, I think increasing taxes might have happened under Hillary. It's certainly not something that we would expect from Trump. It's because I think it would be downright suicidal in many different ways. Funding by the private sector. Well, you want the private sector to fund the debt? That's deflationary, as I just said. Money funded by the private sector is deflationary. And that won't bring jobs back to America either, because you'll be driving the dollar higher if you have higher interest rates, because that's what it's going to take to get the public to buy the debt, is higher interest rates. So I don't think that that's going to happen. The most likely one is that we're going to be doing more of the same that we've been doing in one way or another. Now, we could see interest rates rising. We could see, I expect that we won't see real interest rates rising. I think that as in the 1970s, rates rose and everything, and prices continued to rise, rates rose, and the Fed was always behind the curve until Volcker came in 71 and put his foot on the brake, and my first mortgage was 17.5% back in 1981. I think that is not thinkable, that a Fed chairman would do something like that unless the Fed might want to destroy Donald Trump. That may be one possibility, I think. I think that Ms. Yellen could keep her foot on the brake and just throw this thing into one heck of a decline, and the Donald would be, they wouldn't have to use a bullet. They could use something else. And that could be one possibility. The other thing is, if Trump is able to go forward with his trade policies, I think it could really wreak havoc in the global economy, and we could see, I think we could see the destruction of the dollar and the dollar hegemony that's been in place, and a new system. Because these monetary, keep in mind it was 1971, not that long ago, we had a completely new monetary infrastructure put in place. And now this one is wearing out, I argue, because of the things we're talking about here. Now, most of us are gold investors, I would imagine, gold share investors. This was a chart that I picked up from one of the Sprotts people up in Toronto a few months ago. And it shows that we've had, this is the TSX, S&P TSX Gold Index. And it shows that we've had these increases, you know, anywhere around five-fold, but, you know, as high as 760%, 607%. So we've had these big increases, only to be followed by a very sharp 80% decline. So how do we know when to get off the wagon? How do we know when to get off the bus? You know, we have to know when to get out. The main thing to watch, and easier said than done, no doubt, but is the real interest rates. And the trend of real interest rates, and especially negative interest rates, are very, very bullish for gold, the gold bullion. And you can see here the gold price and the lighter areas going negative there below 1,000. That's when we were, or below zero. That's when we were in negative interest rates. And you can see the correlation. Whenever we went negative interest rates, gold really did extremely well. This is just a chart that shows the monthly average real interest rates. And if we had time to look at it and dwell on it a little bit, you could see that as we went up from 2008 to 2009, the real interest rates went up. That's when we had the crash in the economy. And then after that, when they started coming down, is when we had the gold bull market until 2011. And so this really fits very well, this real interest rate with recent experiences in the gold market. I mentioned Michael Oliver, and just because I'm running out of time here, but he's just been the best technical analyst that I've personally come across, and he uses a momentum system that really seems to work extremely well. And momentum usually gives a signal before price does. So most of the technical analysts are price chartists, and they're looking at price. But Michael's stuff really works well. And he was getting a little bit close. He was very bullish on gold. And this was back in the middle of December. He put this out. He said, if we see something less than 11/19/60 by the end of December, he'll turn neutral instead of bullish. Well, we come to 11/22 and stop there. And now it's looking very, very bullish. He thinks if we're ahead of 11/90 by the end of this month, we're off to the races again for another bull market. And of course, it's looking pretty good now with gold at 12.10 or something like that. This is GDX, and he's showing a breakout there among his momentum zero line, and he's extremely convinced that we're on to another bull market in the gold equities now. Just to give you a little idea of the relative value of gold shares, and this is a little dated because this is from my experience at Sprott back in August, and we're looking at so it's a little dated. We've had a nice run-up since then. Price to cash flow multiples, still very, very low compared to historical norms, and long-term gold equity to the gold price ratio, still very, very low. Now, we're getting to the companies that I've invited here and the ones that are on the stage: Corvus Gold, Falco Gold, TerraX Minerals, and Riverside. And the others that I've covered that are here: Aran, Millrock, Marisol, and Osisko Gold Royalties. So I just, in getting ready to introduce my guests here, Corvus Gold is really, I think, a very undervalued stock. It's had some very interesting 2016 drill program that suggests the mineralization system is getting bigger. They've had a PEA that's pretty robust, but I think things are getting better. It looks like as they're drilling north, things are getting better, but we'll hear about that momentarily. It should expand, I think, perhaps the grade, but certainly the size of the deposit, I think the grade as well. Falco Resources is really, if you like Agnico Eagle and followed that company going way back with their mine, with their mine that made the company making mine, it was very similar, the polymetallic mine. And Falco has this previous mine that was put in production by Norando that was really very much more of a copper. They were looking for the copper. But this, I think, is going to be better than the LaRonde mine that Agnico Eagle has and made them the company. The costs look like they're going to be lower, quite a bit lower, but you'll hear more about it in a minute. TerraX is really, I think, a very exciting story with all they have going up there in Yellowknife, and Osisko Gold Royalties in there. Just really, now some work they did this year suggests that maybe they might have some bulk tonnage potential, although the primary focus is high grade, and some very, very high grade mines have come out of this area, of course, in the past, some of Canada's highest grade mines. And Riverside Resources is probably the company that I've had on my list the longest. I've known Dr. John Mark Stade for 10 years now, and I just think they're getting very close to the time when their 37.4 million shares are going to richly reward the people. Because to have a company for 10 years and have only 37 million shares outstanding, and continue to get rid of projects that aren't looking as good, to sort of cull the projects and narrow them down, and with some major mining companies looking for major deposits that are working with Riverside, I think the chances are very good that we could see this being Riverside's year. So I just hope that you'll listen to what Dr. Stouty has to say. So I think we're off to possibly the greatest bull market ever. I mentioned I hope and pray we don't see some sort of a major monetary regime change. I'd like to see something more peaceful and stable. But I think whatever we have ahead of us it looks very perilous to me for the global world, for the world we live in. But certainly it's gold bullish, I think, for the reasons that I explained. So that's it. I hope you'll listen to my show, the J. Taylor Media. A lot of the speakers here at this show are on my radio show from time to time, but I have a lot of other marquee speakers that are well-known, maybe in the States more than Canada, but David Stockman, Ron Paul, and a lot of other interesting people. So that's it, and we'll get on to the company stories now. Thank you very much.